Hi, this is Mark Santero, President and CEO of the Homestead Group, and welcome to the third quarter 2021 market review. Topic for today is stocks pause as inflation persists. We appreciate everybody joining our third quarter webinar. With me today are two senior portfolio managers from the fixed income team, Mauricio, and from the equity team, Prabha. You've heard from them in the past, and we're looking forward to their comments third quarter and also what's ahead. The agenda is typical as you've followed us in the past. We will discuss the macroeconomic conditions and factors that affected the third quarter. We'll talk a little bit about fund absolute and relative performance, and specifically the drivers of return for the funds. And then last, but certainly not least, the outlook and fund positioning going forward, which I'm sure everybody is curious about given the current market conditions we've experienced this year. So as we go forward, let me turn it over to Prabha to talk about the third quarter and specifically how stocks pause as inflation persists. Prabha?
Thank you, Mark. I'll start with slide 5. Thank you for taking time to hear our story and listen to our update. After 5 quarters of rallying and 54 record closes for the year, the S&P 500 paused during the third quarter. Although it technically eked out a 0.2% return, the averages, after being strong for most of the period, peaked out around early September. Headwinds, which we will discuss, include concerns about reduction in liquidity from the central banks, supply chain issues, energy commodity inflation, rising labor costs, and difficulty finding workers. However, we are still constructive on the U.S. markets. Some tailwinds include the U.S. consumer being in its best shape in terms of net worth in a long time, the strength of the U.S. banking system, and efforts by policymakers to continue to revive the U.S. and global economies. Policymakers have brought us from the depths of the pandemic-induced economic slowdowns. Now to discuss fixed income, I turn to Mauricio.
Thank you, Prabha. During the quarter, we experienced a period of volatility in the U.S. Treasury market, something that we have seen the entire year. Yields for the better part of the quarter trended lower as the global economy assessed the potential of the Delta variant, the potential impact. For instance, the 10-year yield closed as low as 1.17% in early August after starting the quarter at 1.47%. However, the 10-year yield ended the quarter at 1.49%. So when we look at the quarter over quarter, the 10-year yield only moved up 2 basis points, but in between we saw a lot of volatility as economic data came in. Some of the data was not as weak as forecasted, with inflation in particular remaining relatively high by historical standards. The labor market has also recovered, although the overall labor force participation rate is still lower than pre-COVID. Against this backdrop, bond funds returns were relatively flat for the quarter, with the Bloomberg US Ag Index returning a positive 0.05% for the quarter. So now let's turn to review performance for the short-term bond fund for the quarter. The fund returned negative 0.1% for the quarter versus a positive 0.03% for the benchmark. This brings year-to-date returns through the end of September of negative 0.23% for the fund and negative 0.18% for the benchmark. What worked during the quarter? The fund's overweight allocation to financials, industrials, and ABS sectors. Despite the volatility in U.S. Treasuries, credit spreads remained stable for most of the period. We believe this is a reflection of the overall health of the economy and the continued recovery post-COVID, as Prabha previously mentioned. What didn't work during the quarter? The fund's yield curve positioning detracted from performance, in particular the 3-year and 5-year part of the yield curve. Additionally, the fund's underweight allocation to BBB credit also detracted during the period. Next, in terms of portfolio positioning, at the end of the quarter, the portfolio had a duration of 2.5 years, slightly short of the benchmark at 2.63 years. The portfolio remains overweight corporate bonds, ABS, and munis versus underweight U.S. Treasuries. We still have a fair amount of conviction in credit spreads, even at these tighter levels, as we remain optimistic on the economic recovery. Next, for the intermediate bond fund, the fund returned negative 0.08% for the quarter versus a positive 0.05% for the benchmark. So again, pretty flat returns for the quarter, bringing year-to-date outperformance versus the benchmark of 66 basis points. Now, what worked during the quarter? The fund's overweight allocation to financials, utilities, industrials, and ABS sectors. The environment for corporate bonds continued to be constructive, and therefore the positive contributions to overall performance. What didn't work? Similar to a short-term bond fund, the fund's underweight allocation to treasuries detracted from performance. Additionally, the fund's yield curve positioning hurt relative performance, with the 20-year and the 30-year part of the yield curve being the culprits. Next, the portfolio's duration remained shorter than the benchmark, ending the quarter at 6.5 versus 6.67. Additionally, we remain overweight corporate bonds and asset-backed securities, while underweight in treasuries and mortgage-backed securities. With that, let me turn it over to Mark to introduce the new fund.
Thank you, Mauricio. Hopefully many of you are aware we launched a new fund in May of this year, the Rural America Growth and Income Fund. So this is the first time you'll be hearing about performance for this new fund. Granted, it's only a couple of months old. We thought it important to include in our presentation. Hopefully, as the fund matures and goes at least 1 year into performance, as we grow this fund with the benefit of our shareholders, we'll have more to discuss. But I'm going to turn it back over to Mauricio and Prabha to talk about the fixed income component of the portfolio and the equity components of the portfolio and how that's positioned and how excited we are about the companies and securities that we invest in this fund that benefit our rural economies to which our co-ops exist. So without further ado, back to you, Mauricio.
Thank you, Mark. We are certainly very excited about the Rural America Growth and Income Fund and the level of collaboration between the equity team and the fixed income team at Homestead. The fund for the quarter had a solid return against a flat market. It returned a negative 0.2% versus 0.02% for the blended index. The portfolio remains well diversified. Currently, we target a 60% equity mix and 40% fixed income, give or take a few percentage points. Like at the end of the quarter, we held about 4% in cash. From a portfolio composition standpoint and the fixed income side, we maintain a duration of about 4 years versus 4.1 for the benchmark. We are overweight corporate bonds, mortgage-backed securities, municipals, and asset-backed securities versus an underweight in U.S. Treasuries. We focus on bonds that hit at the heart of rural. For instance, one of the top holdings of the overall portfolio is the Federal Farm Credit Bank. This is an agency whose sole purpose is to issue debt on behalf of the banks of the farm credit system to support rural communities and U.S. agriculture. Now, let me turn it over to Prabha to provide more background on the equity allocation to the fund.
Thank you, Mauricio. On the Rural America Fund equity portion, as Mauricio and Mark mentioned, it is in its early days. The fund addresses, as Mark mentioned, our larger mission of serving rural communities. And as Mauricio pointed out, the fund highlights our cooperative culture between the fixed and equity teams. We are pleased with the fund's recent blended performance. The portfolio's holdings have a well-defined rural heritage. It's a diversified portfolio emphasizing the richness of rural America, not a monolith. Now I'll go on to the value fund. The value fund is our large cap fund and we experienced slight underperformance in the near term, but the 3, 5, and 10-year returns are benchmark beating. Though our 1-year return lags the Russell 1000 value, the absolute return of over 32% is attractive. The PE on the portfolio is 1% point lower, and the fund's aggregate ROE is 4.5% higher than the benchmark with less leverage. This value fund portfolio is more profitable and cheaper in valuation. Again, this addresses our overall process where we look for quality companies that reward shareholders over the long term. What worked in the quarter? Communication services helped. We were underweight but outperformed with stock selection. Alphabet was a contributor. Financials also contributed. It's our largest sector weight. Here we were overweight insurance. AIG and Chubb were strong performers in the period. Banks generated mid-single-digit performance with good credit and prospects for loan growth in upcoming periods. There was also strong fee income in wealth management, capital markets, and specialty areas. Deal making is set to eclipse 2007 records of 4.3 trillion. We're already at 3.9 trillion in global deals year to date. What detracted? Industrials, especially the machinery subsector, was weak. And here it's just a question of concerns about the macro and some of the supply chain issues that we previously mentioned. Will companies be able to pass costs through? Do our companies have pricing power? Again, it was just a quarter, but we like our holdings. Healthcare and healthcare service providers were also weak and underperformed. We feel healthcare providers are part of the healthcare solution and represent compelling values. I'll go on to small company fund on the next few slides. Small is ahead of the Russell 2000 benchmark for the year to date and the quarter. On the 1-year number, the fund is behind, but the absolute return of over 39% is again rather striking. As the metrics table shows, our small cap portfolio carries a PE multiple close to the Russell 2000 benchmark, but the ROE is 5.9% versus a negative number for the benchmark. Again, this Homestead portfolio has lower leverage. According to recent stats, over 45% of the Russell 2000 benchmark components are non-earners. Again, we have a quality bias. So what worked in the quarter in small cap? Healthcare technology helped. Here, Novalon, a data analytics company, received a takeover offer at a 23% premium from private equity and the founder. Shenandoah Telecom was another strong performer during the period. Financials, where we're slightly overweight, contributed. Banks were strong, especially FB Financial, a Tennessee-based bank with strong mortgage operations. What detracted? Industrials. Here we were overweight and underperformed. Industrials are a broad sector. The construction subsegment was notably weak, and for the same reasons I mentioned with large cap. Small cap machinery and aerospace also detracted during the period. However, Atcor was a very strong performer in the industrial space in the period. Now back to Mark Santoro.
Thank you, Prabha. Thank you, Mauricio. So we've looked in the rearview mirror about the third quarter, and it's been quite an interesting year from a markets standpoint, given the pandemic and then the aftermath of the pandemic, although it's not over. What result? People back to work, economy opening up, the rebound trade in the first quarter, second quarter, and then slowdown in the third quarter. And 4 themes are really prevalent as we look going forward. First is inflation and how that affects the economy. And certainly what affects inflation are the persistence of the supply chain issues, energy concerns, and labor concerns. 3 things wrapped around inflation that short term, when I say short term, 18 months and out, will affect the economy. So let's hear from Mauricio and Prabha on what we see in the short term, certainly for the rest of the fourth quarter and into 2022. So Mauricio, speaking of inflation, please share your thoughts.
It's certainly something that we're watching carefully, and the potential effects that a sustained period of inflation could have on the U.S. and global economy. As we illustrate here, inflationary pressures have been stickier than anticipated, with all regions showing sustained inflation. Additionally, wages have gone up. Employers, they need labor, and one way to attract employees is with higher wages. The Federal Reserve has stated that they are paying attention to these dynamics and the inflation picture. The 10-year yield has gone up in anticipation of future expectations for higher inflation. Volatility remains a key driver in the Treasury market, and that's a major component of fixed income returns right now. The Fed will also start tapering its asset purchases of Treasuries and MBS in the next couple months, with the goal to end by the middle of next year. The Fed has made it clear that tapering asset purchases has nothing to do with raising Fed funds rate. As I mentioned, we are carefully watching this dynamic because a sustained period of inflation could prompt the Fed to raise rates sooner than currently forecasted. That being said, we welcome slightly higher rates as it allows to reinvest coupons and maturities at higher yields to the benefit of our shareholders. Lastly, we will maintain the portfolio's duration shorter than the benchmark for the foreseeable future as part of a defensive strategy and from the fixed income team. Now, for some equity perspective, let me turn it over to Prabha.
Thank you, Mauricio. I know questions about, as Mauricio said, is this inflation transitory, persistent, permanent? And this chart, as the descriptive on this slide states, in periods of low but rising rates of inflation, less than 3%, the definition, the first bar, equity returns have been greater than rates of inflation 90% of the time. And the stats for this chart date back to 1973. So we have a long-term lens and a record of generating returns with high quality portfolios in both the large cap and small cap realm. As Mauricio said, we're monitoring it closely, but we're optimistic as equity managers are wont to be. Now I turn it back to Mark.
Thank you, Prabha, and thank you, Mauricio. As always, we want to thank our shareholders for your support and confidence in us managing the Homestead funds. That is my phone number and that is my email if you have any questions on some of the information that you heard. As we look to end the year, we're optimistic in the positioning of the portfolios. We're optimistic into 22. The U.S. economy is strong, and we're confident that we will navigate the funds to meet that strength in the economy. We appreciate everyone, and we look forward to working hard and managing the portfolios. Have a wonderful day. Thank you very much.